In 1999, millions of ordinary people believed they were financial geniuses, not because they had studied economics, not because they had built successful businesses, but because they bought internet stocks and watched them explode in value. College students quit school to trade full-time. Office workers stared at stock tickers instead of spreadsheets. Companies with no profits, no products, and sometimes no customers were suddenly worth billions of dollars. The internet promised a new economy. Old rules were dismissed, risk was ignored, and anyone who questioned the hype was told they just didn't get it. This is the story of the dot-com bubble, the moment when paper websites became billion-dollar illusions, and the crash that wiped out millions of investors almost overnight. Welcome to the Financial History Channel. The internet feels like magic. To understand the dot-com bubble, you have to remember what the internet felt like in the early 1990s. Email was revolutionary. Search engines replaced libraries. Online shopping felt futuristic. For the first time, anyone with a computer could reach the entire world. This wasn't just a new technology. It felt like a new era of civilization, and investors believed they were standing at the beginning of something bigger than electricity, railroads, or automobiles. The logic was simple. Whoever dominated the internet would dominate everything. The race to get rich. First startups exploded across Silicon Valley. A new company didn't need factories or inventory. All it needed was a website and a catchy name. Venture capital firms poured in money. Investment banks rushed companies to IPOs. The stock market became a launchpad, and speed mattered more than substance. The goal wasn't to build a profitable business. The goal was to grow fast, the death of old rules. Traditional investing focused on boring things: revenue, profits, cash flow. During the dot-com boom, those ideas were treated like relics from the past. Instead, investors were told to focus on website traffic. Page views, eyeballs. Brand awareness companies proudly announced massive losses, and their stock prices went up. Losing money wasn't a weakness, it was a strategy. Lose money now, rule the world later. This became the unofficial motto of the era. Companies burned cash at historic rates. Free shipping, free services, massive advertising campaigns. The assumption was that once competitors were crushed, profits would magically appear. But no one could explain how, and no one wanted to ask. Pets.com, the perfect symbol. Pets.com became the most famous example of dot-com excess. It sold pet food online. The problem was obvious. Shipping 40-pound bags of dog food cost more than the food itself. Every sale lost money. But Pets.com had a sock puppet mascot, a Super Bowl commercial, massive media coverage. At its peak, the company was valued at hundreds of millions of dollars. Within 9 months of its IPO, Pets.com shut down completely. It didn't fail because people didn't love pets. It failed because the business model never made sense. Warning signs ignored. A few analysts warned the bubble would burst. They were mocked. Old economy thinkers, dinosaurs, too cautious. After all, how could the internet fail? The moment everything changed. In early 2000, cracks began to form. Interest rates rose, earnings disappointed. A few high-profile tech stocks stumbled. Then investors did something radical. They asked a question they had ignored for years. How does this company make money? And suddenly, silence wasn't acceptable anymore. Panic spreads. Once confidence cracked, panic spread fast. Investors rushed to sell. IPO windows slammed shut. Venture funding dried up overnight. Companies that depended on constant cash infusions collapsed first. Others followed. The crash. From 2000 to 2002, the dot-com bubble imploded. The tech-heavy stock market lost nearly 80% of its value. Trillions of dollars vanished. Thousands of companies went bankrupt. Millions of jobs disappeared. Retirement savings were devastated. Some investors never recovered. But not everyone died. Despite the destruction, a handful of internet companies survived, and their survival tells us everything. Amazon, survival through discipline. Amazon was written off as a future failure. It lost money for years. Its stock fell more than 90%. But Amazon had something most dot-coms didn't. A real business plan. Jeff Bezos cut costs, focused on logistics, built infrastructure, expanded carefully. Amazon didn't abandon growth, but it demanded discipline. eBay, profitable from the start. eBay survived because it did something radical. It made money. By taking a small fee from each transaction, eBay created a scalable, profitable model early on. It didn't need endless cash infusions. It didn't subsidize bad economics. It let users build the marketplace. Google, timing and focus. Google arrived late to the party, but it focused on one thing: search. And it found a way to monetize attention through advertising. Google didn't chase hype. It solved a real problem, and it waited for the right moment to scale. Why most failed and a few survived. The survivors shared key traits: clear revenue models, cost control, patience, focus on fundamentals. The failures chased growth without direction. The difference wasn't technology, it was discipline. The real lesson of the dot-com bubble. The internet wasn't the illusion. Human behavior was. The bubble was fueled by greed, fear of missing out, blind faith in narratives, and those forces never disappear. Why this still matters today. The dot-com bubble didn't end speculation. It taught it new costumes: housing bubbles, crypto booms, meme stocks. The dot-com crash wiped out millions overnight. But it left behind a warning written in financial history. When profits don't matter, when fundamentals are dismissed, and when everyone believes they're a genius, the crash has already begun. If you enjoyed this deep dive into financial history, make sure to like this video, subscribe to the Financial History channel, and share it with someone who remembers the dot-com boom or wishes they'd understood it better. Because history doesn't just tell stories, it leaves clues.